attendees are in listen-only mode.
Welcome to the March NARPM e-Chapter webinar. These webinars were specifically designed for the NARPM at-large members who did not have a chapter to service them. All members of NARPM are welcome to attend any of these webinars. NARPM's mission. NARPM is the professional, educational, and ethical leader for the residential property management industry. Article 8 of the NARPM Code of Ethics, Commitment Affirmed. The property manager shall act in the best interest of their employer, broker. Standard of Professionalism 8.1. The property manager shall not have any undisclosed conflict of interest with their employer, broker. If a conflict should arise, the member shall notify their employer, broker immediately. The property manager shall not receive any form of compensation, rebates, or other business benefits without full disclosure to employer, broker. The property manager may not take or use any proprietary documentation or client-tenant lists during or after relationship with employer, broker without express written consent from employer, broker. The program for today is presented by NARPM and IRA Innovations. The title of the program is Using a Self-Directed IRA to Create Dependable Passive Income with Real Estate. Bill Goulis will be doing our presentation today. Just as a note, please remember to type your questions in the question box and they will be addressed to the presenter at the end of the program. This video will also be posted on the website at the link on the agenda. And now we turn the program over to Bill.
Good afternoon, everybody. I want to thank everyone for coming to the webinar today and taking the time to join us to learn about self-directed IRAs, how they work, and how they can be used to grow your business. This webinar will be about 30 minutes, and just as Gail said, if you can think of any questions during the presentation, just type it in the question box on the lower part of the GoToMeeting control panel. As Gail said, my name is Bill Goulis, and I've been in the self-directed IRA business for over 11 years. I've worked with all types of investors in all 50 states to help them invest in what the industry terms alternative investments, assets other than stocks, bonds, and mutual funds. The webinar this afternoon is for educational purposes only. I am not an accountant, attorney, or financial planner. I do not provide any tax, legal, or investment advice. What I do is educate people on the full breadth of investments allowed by the IRS, some of the restrictions that apply, and who these plans can work with. If you're needing financial advice, please consult your legal, tax, or accounting professional. So, why should self-directed IRAs be important to you? Because they're a fantastic tool to grow your business. Business strategists say one of the fastest ways to grow your company is to sell more product to your existing clients. Why? Because you don't have to sell them. They already like what you provide and enjoy dealing with you. If they didn't, in this competitive environment, they wouldn't be your clients. So by learning about self-directed IRAs, you can potentially manage more doors with the same client base because you can buy more product and they can buy more product and give it to you to manage. If you sell property, here's an opportunity to sell more to your existing owners. And by showing them how to use a self-directed IRA to purchase real estate, you establish yourself as an expert and build credibility in your local market. So if your clients like real estate as an investment and want more property, what's the problem? Simple. They're out of money. But if you suddenly found them a stash of cash, they would probably use it to buy more real estate and give it to you to manage. So show them where they can find this stash of cash. Let them know it's in their retirement account. Yes, IRAs can purchase real estate as an investment. I'd say over 90% of people are unaware they can purchase real estate in their retirement plans. They think they are limited to stocks, bonds, and mutual funds, but that has never been the case. IRAs were created by an act of Congress with the passage of the Employment Retirement Income Security Act of 1974, or ERISA. ERISA allowed people to invest some of their savings on a tax-deferred basis. The Act did not specify what you can invest in. It detailed what you cannot invest in. And that list is very short. IRAs cannot invest in collectibles and life insurance. The IRS code goes on to define collectibles as artwork, rugs, antiques, metals, gems, stamps, or coins. However, certain precious metals are allowed. They must be either gold, silver, or platinum American Eagles, or bullion. Alcoholic beverages are not allowed, and neither is life insurance. That's it. All other types of investments, including real estate, are allowed within your IRA. So why don't more people know about it? Because after ERISA was passed, banks and brokerage houses did such a good job of marketing IRAs that just about everyone believed all you could do were stocks, bonds, and mutual funds. Banks and brokerage houses were not and are not in the business of holding alternative assets and are not equipped to handle these types of investments. And according to the IRS, they don't have to. Here's a screenshot of the IRS website. You can find this at irs.gov under Retirement Accounts, Investments, Frequently Asked Questions, and you'll end up here. As you can see, the question here is, what types of investments can I make with my IRA? And we've already answered that, life insurance and collectibles. And you can see the list here is pretty much the same one that we just went over on the previous slide. However, what I circled, I want to make 2 points. Let me read it to you. IRA trustees are permitted to impose additional restrictions on investments. For example, because of administrative burdens, many IRA trustees do not permit IRA owners to invest IRA funds in real estate. IRA law does not prohibit investing in real estate, but trustees are not required to offer real estate as an option. Let me read that again. IRA law does not prohibit investing in real estate, but trustees, companies that hold IRAs such as E-Trade, Fidelity, TD Ameritrade, Merrill Lynch, are not required to offer real estate as an option, and they don't. Here, the IRS is confirming, yes, you can use real estate, but that trustees may not and are not actually required to hold it as an investment. That's why there are certain companies out there that do allow that, and you've got to use those people to hold the type of IRAs so that they can purchase real estate. So, we've established what you cannot invest in. So what can you invest in? Here's a list, and by no means an exhaustive one, of what IRAs can invest in. Real estate, and that covers any type of real estate. You can use real estate, you can buy and hold and rent real estate. You can buy, rehab, and sell it. You can buy and wholesale it. You can buy real estate under lease options and land contracts. You can be somebody's bank. You can lend money on mortgages or unsecured loans. You can buy tax lien certificates, private equities, that is any non-publicly traded company. You can do accounts receivables or factoring, so you can buy the accounts receivables from a company and collect on their accounts receivables. Precious metals, as we've talked about. Limited partnerships and LLCs, including real estate syndications. Mobile homes, parks, or the individual home. You can fund cars, auto paper. You can do commodity and options trading, equipment leasing, all types of joint ventures, and racehorses. Now, why did I put in racehorses? Racehorses were put in there not because there are a lot of people that do racehorses. The point I wanted to put in there is that whatever you can think of, most likely you can do it with just a few limitations. There are certain rules of the road. There are certain people your IRA cannot do business with. Your IRA is a separate legal entity from you. It has its own tax ID. So you need to think of it as maybe an alter ego, such as a Mr. IRA. And there are certain people Mr. IRA cannot do business with. They are you and your spouse, lineal ascendants, parents, grandparents, and their spouses, lineal descendants, children, grandchildren, and their spouses. Any fiduciary of an IRA, that'd be anybody that holds the IRA, financial planners, those type of people. Corporations, partnerships, trusts, or estates, pretty much any type of entity in which you and any other disqualified person own directly or indirectly at least 50%. So what does that mean? So if I've got a company and me, my wife, and my son own 20% each one of us individually is not disqualified because we don't own 50% or more of the entity. However, together, since we're all three disqualified people, together we own 60%, which is in excess of that 50%. So the IRAs cannot work with that entity. And the last one, where a disqualified person has undue influence over the affairs of an individual or company. So what does that mean? Here's a real life example. There was a gentleman that worked for a company. He owned 20% of the company, and he lent the company his IRA. I'm sorry, he lent the company money from his IRA. Nothing different from any other lender. The terms were pretty much what you'd find in the market. The rates were the same. He actually did it twice. The problem is that in the fact that he lent and only had 20% just by the code, that was fine. But he was the CFO of the company and therefore disqualified because he had undue influence as the CFO over the affairs of the company. And this resulted in what's called a prohibited transaction. So what is a prohibited transaction? Prohibited transactions occur when IRAs work with disqualified people. That's basically what it is. And here it is right out of the IRS code. An IRA cannot engage in any transaction, direct or indirect. Indirect meaning through a third party with anybody or anything considered related to the IRA, related being a disqualified person. So, two key points. No self-dealing. If you've got real estate currently that you own or any disqualified person owns, you cannot sell it to your IRA. Your IRA, by owning real estate, cannot sell it to any disqualified person. And then also included in that is no personal benefit. The overall arching theme of the retirement section of the IRS code pretty much says is that all this is for retirement. You are not to get a personal benefit out of assets within your retirement today. So what happens if an IRA engages in a prohibited transaction? Well, it's considered distributed to the owner at the time of the prohibited transaction, and there are additional taxes, penalties, and interest. Now here's an example I get probably once a month. I'll have somebody call and say, my daughter's going to college next year and I want to buy a condo down there with my IRA, and she and 3 of her friends are going to use it and rent it. Can I do that? And obviously the answer is no, because the daughter is a disqualified person. Well, what if she doesn't pay, what if she pays rent? Will that do? No, you can't use it. There is no personal benefit at all from an IRA. Well, what if she doesn't pay rent and the other 3 do? No, because she's still living there and she is receiving a personal benefit. Well, what if she's just there to visit? No, you can't do that. Who's going to know is the final question I get. I said, well, I can only tell you what the rules are within the IRS. I said there are, if it is ever found out, there are, as I'd said, distributed at the time that the transaction occurred, additional taxes, penalties, and interest, and they are substantial. And so what I say is there are so many things you can do with your IRA and so few things that you can't. It's just best to stay away from the things that you can't. So here's some other examples of prohibited transactions. We've already talked about selling, exchanging, or leasing property between the plan and disqualified people. Lending money or extending credit, you can't do that. Now there is an exception in borrowing money from a profit-sharing plan like you have at work. You can, as the beneficiary of that, you can actually take a loan from a 401k plan or profit-sharing plan, but you cannot lend money out of IRAs or extend credit. Furnishing goods, services, or facilities out of the IRA. Transferring income or assets within an IRA. Using the income or assets for personal gain. And this is an example, is that you've got the property and they're collecting rents, and the rents then you use. They don't go, instead of putting them back in the IRA where they belong, you start collecting them and using them and cashing them for yourself. Use of property personally by any disqualified person, and we talked about that just a few minutes ago. And one thing I'd like to point out here too that I talked about is that when an IRA owns the property, since the IRA is a separate legal entity from you, anything that the IRA generates, any income that is generated by the IRA goes back into the IRA. Any expenses associated with that asset must be paid by the IRA. And we'll talk about that in just a minute. But just so you understand that all that, and then of course when it's sold, all the profits go back into the IRA. Now we talked about IRAs, and the question comes up, well, what are they? Well, there are different types of IRAs, and here's pretty much a list of them. Most people are familiar with the traditional IRA. It is a tax-deferred plan. What I mean by that is that money that you contribute to a traditional IRA is not taxable to you. You can write it off on your taxes as if you had never earned it. So the money goes, and that's tax deferred because the taxes have been deferred on that income. So the money goes into the traditional IRA, tax deferred. Any profits or any income that's generated by that money is not taxed at that time either. So the whole time that that money is in your IRA doing buying and selling assets, no tax is paid on it. The only time that then when you're ready to take out money at your retirement, then at that point it's taxed as ordinary income. So just like it went in there and it was like as if you had never earned it, when it comes out, it's added to your earnings for the year that you take it out. Now, the traditional IRA, this year the contribution limit is $5,500 with a $1,000 catch-up contribution for anybody 50 and older. We'll skip the Roth right now and move to the SEP and Simple. Those types of IRAs are associated with small businesses. SEP, the self-employment plan. And the advantages of those is that people that own businesses can open these types of accounts, and the amount that can be contributed is much greater. For the SEP, I think this year it's somewhere around $52,000. Actually, it's around $52,000 or the greater, either $52,000 or 25% of your income, whichever is less. Go down, and again, both SEPs and Simples are tax-deferred types of accounts. Go to a rollover IRA. A lot of people have profit-sharing plans at work. They leave work and they can take their profit-sharing plan with them. Those include 401ks, 403bs, 457s, all those, once you leave employment with the company, can be moved to a traditional IRA, and at that point it's treated as such. Now we'll jump back to the Roth. The Roth was not created when ERISA was first passed. The Roth came about 20 years later in the late 90s. And the difference between a Roth and the rest of them is that contributions to a Roth are after tax. So you pay taxes on the money that's contributed to the Roth, but then everything in the Roth, anything, all the investments, all the gains, all the profits in the Roth, when they are taken out, are tax-free. So any monies that go into a Roth, even though you pay taxes on it, when it goes in, anything that's generated, profits, rents, anything else, when it comes out, is tax-free forever. So that's why a lot of people are real high on the Roth. All that money that you go in there you can use, and it comes out tax-free. Now, currently, and it has been the case since 2010, because Roths have some limitations as to contributions. Right now, the contribution is $5,500, just like the traditional with the $5,000 catch-up contribution. And there are some income limitations. However, since 2010, you have been able to convert monies from a tax-deferred plan, traditional, SEP, or simple, over into a Roth. And there are no qualifications for that. So let's say you've got a traditional IRA, it's got $60,000 in it, and you think you're going to be able to grow that 10 times over the next 20 years. And so instead of wanting to pay later, you decide that you want to pay now. So you convert all or part of it, doesn't have to be all of it, all or part of the traditional IRA to a Roth. Taxes are due on that conversion in the year that conversion is made. So in that same example, let's say I converted $40,000 from my traditional to my Roth. And so now it is if I had an additional $40,000 of income in the year I did that. And so it would be considered ordinary income. I'd have to pay taxes on it that year. But everything that is generated from that $40,000 in my Roth is now tax-free forever. So as I heard someone say not too long ago, he says you can pay on the seeds today or pay on the harvest tomorrow. So that's why a lot of people are doing Roths. The last two really are not retirement accounts, but they fall under the purview of being self-directed. Coverdell education savings accounts are accounts that can be set up for children or grandchildren, and actually anybody can contribute to them, and they can be used for educational purposes only. So you can contribute, well, up to total contributions to a Coverdell per person is $2,000 a year, and those plans can also be self-directed. And then the health savings account. You can open a health savings account, you can contribute, and to have a health savings account you have to have a certain health insurance policy that allows health savings accounts called a high deductible policy. And then you can contribute, depending on if it's family policy or an individual policy, money into a health savings account. All those monies can be self-directed, and then when that money is taken out, it can be taken out for health costs, and it is taken out tax-free. Health costs include not just doctor's visits, but eyeglasses, prescriptions, wheelchairs, if need be, those type of things. And they don't have to be in the year that they happen. So if you want to, let's say the first 5 years of a health savings account, you contribute and you can put, the maximum in there, and then you can self-direct it. Now you've not just have the contributions, but you've made money off those contributions. Now you can start paying those expenses even from the first year you had the health savings account. They are still available expenses that can be paid. You just didn't have to pay them in the year that they occurred. So now we got a pop quiz, and Gail, I think, is going to have. Gail? I'm not sure what's going on.
Can you, oh, I have to show I need you to, here you go.
There you are.
Oops.
Ah, okay.
Do you see it?
Yes.
Okay, we have 100%. I'll give you back the screen.
Okay. The second question? You got the second question?
Are you ready for it? Okay.
Yes, all three of them right here.
Okay.
You got to take back the screen.
Hold on one second. I lost it. Okay. Okay. Did you want?
There, I'm back. So the question is, can your IRA purchase real estate? Obviously, the answer is yes. We've gone over that a number of times. Can you live in real estate purchased by your IRA? Well, since you're a disqualified person, and disqualified persons cannot benefit from assets within the IRA, that answer would be no. And then the third one, can you personally collect rent for your IRA? And because you cannot provide services to your IRA, that answer would also be no. So no, yes, IRAs can purchase real estate. No, you can't live in it. And no, you cannot personally collect rent for your IRA. So the question comes up, what is the process? How do you make this work? What are the steps to do that? And I think the best way to describe that is to go through a case study. So Ann Smith wants to use her $68,000 in her IRA to purchase a $58,000 house. So the steps. Ann sets up her IRA with a self-directed IRA custodian and funds the new IRA. So you got to have somebody has got to hold your IRA account. A registered custodian broker has got to hold an IRA account. And so if you've got one Merrill Lynch, you can transfer all or part of that IRA to the new custodian. You can have multiple IRA accounts at different IRA custodians, and then you can fund that account between the two, from the first one to the second one. It's not a contribution. You're just transferring funds from that original account over to the new account. And again, you can do that as often as you like, and as much or as little of it as you want to move. These are not IRS reportable events, and so transfers can occur, every day if you choose to. Then Ann locates the property. So she goes out and finds what she's looking for, determines what it is, and initiates the contract. And the contract, she's not buying it. As we talked about earlier, the IRA is a separate legal entity from you, has its own tax ID, is its own legal entity, and therefore the name on the contract must be the IRA. And it's the IRA custodian for the benefit of Ann Smith IRA, and then the account number. So that's how the contract would be written up. And then Ann would approve the contract and submit it to the IRA custodian to sign, because they are the legal representatives of the IRA, and so they'd sign it and then submit the contract back to the real estate agent. Now, a lot of people have heard or think that this process is long and tedious and confusing and difficult to do, and that can be further from the truth, because closing is done just like any other closing. whether it's in the IRA or outside the IRA. So the IRA custodian coordinates the closing with the title company. And again, they work with the title company, letting them know what documents need to be done and usually it's just a deed, a settlement statement, a title binder are really the only things that the IRA would require. The asset is titled again in the name of the IRA, IRA custodian for the benefit of Ann Smith, IRA number 12345. And then Ann would review and approve once all the closing documents are done, Ann reviews and approves them, signs off on them, and then the custodian legally signs all the documents on behalf of the IRA, gets it to the title company, and then funds are wired from the IRA to the title company to close. And that's pretty much it. The IRA is now the owner of record on the warranty deed, and Ann has an additional $10,000 in her IRA to cover expenses, just like we talked about earlier. The IRA is responsible for any expenses that may be incurred with assets that it holds. So now Ann goes out and hires a property manager to manage her property. The property management contract is also sent to the IRA custodian to sign, again, after Ann has approved it. The property manager finds the tenant, collects the rent, and holds the amount they need for escrow. Any extra is sent to the IRA custodian and then deposited into the IRA. And that can be either as a check or an ACH. Each month the property manager collects the rent, takes their fees from the rent, pays any expenses, replenishes escrow if needed, and then sends the balance to the IRA custodian. Now, what happens if there's a major expense? Well, here let's say, in Ann's case, the air conditioner at Ann's property needs replacing. Property manager gets bids and finds a new air conditioner. Ann requests payments from her IRA to be sent to the property manager for the cost of the air conditioner. Now it's been a couple of months, so now not only does she have the $10,000 in the account, but she has also the rents that have been collected over the last 5 or 6 months to do this. Now, in some cases, if Ann wants to set up an agreement with the property manager to receive funds directly from the IRA custodian, then she can set that up, and the property manager can request payment directly from the IRA, in this case after bids and are found on the air conditioner, and Ann approves it. So that's pretty much the process. It's real simple, and this is a simple example, but it's a very common example. There are some other things that can be done. IRAs can partner with other IRAs to purchase real estate. So if I and my spouse want to come together and purchase a property using our IRAs, then both IRAs are on title with the percent of ownership, and then at closing, each IRA is responsible to bring that percentage to closing. Any rents that are collected are split between the two equally on their percentages. Any expenses between the two, again, are split based on the percentage that the property owns. And again, this is probably 80% of the way these go. There are some others that that probably exceed this presentation, but again, it's a simple process. It's easy to do. There's not a problem doing it. But I want to go back to the beginning and kind of talk about where we were at first, and we talked about why self-directed IRAs should be important to you. And now you can see their importance and how this can grow your business. But I know you're thinking, I don't have the time, nor with this presentation, I don't have the knowledge to intellectually talk about self-directed IRAs. And that's where I'd like to offer some help. If you want, I'll do a free webinar on self-directed IRAs to your existing clients. You invite them. I'll teach them what you learned today in this presentation and more. That way you don't have to wait for them to come to you after they've discovered self-directed IRAs. Actively teaching them about money they didn't know they had so they can grow your business. It requires very little effort or time on your part, But for the people that sign up and listen to the webinar, you create an extremely hot sales list. Just let me know. I've enjoyed being here with you today. And now, if there are any questions.
Yes, we had a couple. Give me one moment to pull them up. Oh, 1 second. Okay. First question is, as a realtor, can I sell a property to my IRA and collect a commission?
No. Again, that is self-dealing, and you are benefiting today from that asset because you bought the assets being sold, you're buying it, you're putting it in your IRA, and then you're getting a commission. You're getting a benefit today in the form of a commission, and so the IRS says no, you can't do that.
Thank you. Two sisters own an IRA with real estate that is rented out. Husband of one of the sisters is a professional property manager. Is he considered a disqualified person who should not be managing the property?
Yes, because he's disqualified. Even if, I know they only own a small part, but if any owner owns any part of it, it doesn't matter how big or how small, then all the rules apply. As an example, if you know, I own 80% of a property and my IRA owns another 20% of that same property, I still can't use it because the IRA owns 20%. So anytime that the IRA owns any part of it, the rules apply completely.
Okay, thank you. You cannot loan money via a self-directed fund. That's a question. Just clarifying, I thought at the beginning you said we could, but then heard later no.
You can loan money out of your IRA, but you can't loan it to disqualified people. And so, so yes, you can be somebody's bank. It just can't be disqualified people, or for that matter, any assets that you have in your IRA. So that's that part of it. Now, profit sharing plans have a provision in them where the owner, you in this case, of a profit sharing plan, not an IRA, a profit sharing plan, can borrow money, and that's part of, and you can borrow it for yourself, and that's just part of the way profit sharing plans were established. So in a profit sharing plan, you can borrow money for yourself, and there are certain limitations, and usually based on the plan that your employer has. But in an IRA, you cannot.
Okay. I'm a property manager, so can I be hired by my IRA to manage the property as a rental for the IRA? I would collect the rent but pay it back to the IRA, not me.
All right. As a property manager, you can manage property, but you can't manage any property that any disqualified people own. I mean, any disqualified IRA. So if you've got a property in your IRA, you cannot be the property manager because you are providing services to the IRA, which is one of the prohibited things that you can do. And so, no, you can't. You can obviously provide services to other self-directed IRAs, just not to any that belong to disqualified persons to you.
Okay. And someone asked if you can be contacted outside the webinar. Of course, Bill will give you his contact information.
There it is, right on cue.
And then can you donate funds to your real estate IRS on a yearly basis? IRA on a, sorry about that. Can you donate funds to your real estate IRA on a yearly basis?
Yes. And self-directed and real estate IRAs are really industry jargon because all IRAs are the same. Any IRA can invest in real estate. Any IRA can do stocks and mutual funds. You know, we went over that list. The difference is the type of companies that hold them. And so IRAs in one company are the same as IRAs in another company. It's just that there are certain trustees that may limit you on what you can do. So yes, contributions to an IRA can be made, at any time during the year into any of the IRAs that you have. They just can't exceed the total maximum of the contributions. For example, in a traditional, you can have 3 or 4 traditional accounts in different places. The contributions for the year for all of them cannot exceed $5,500 unless you're over 50, and then you have an additional $1,000 catch-up contribution. So yes, you can. And then also, up until April 15th, you can contribute to your IRAs for last year. So in this period, if you've got an IRA and you haven't contributed for last year, you still have a chance to make those contributions up until the filing date for your income taxes.
I think you've already answered this one about being your own property manager. It says, what if you as a property manager want to use a self-directed IRA to purchase real estate? And I think you already answered that as no, you cannot manage it yourself.
That's correct.
Do payments from IRA get taxed with a penalty? Do payments from IRA get taxed with a penalty?
I'm not sure of the question.
Okay, that's fine. We have a lot of others, so we can move on.
Okay.
For a small business, what if some of the retirement is held as profit sharing or KIOG, CNA, that be put into a self-directed can that be put into a self-directed IRA in combination with a regular IRA to buy property?
It depends on the profit sharing plan documents. There are certain, and depends on how it's written. Profit sharing plans can be self-directed. You'll find those type of profit sharing plans in your smaller professional organizations, your engineering companies, your accounting firms, your doctor's offices. Those types have self-directed profit sharing plans. There are other profit sharing plans, if it's written in the plan, that will allow you to take, while you're still employed there, that will allow you to take money out of the profit sharing plan. Take money is not the word. Allow you to transfer money out of your profit sharing plan to a traditional IRA, and then you can self-direct the traditional IRA. So it really depends on the plan that you're under and what's been written into it. The ability is there, but not all employers give that flexibility when they write their plan.
Can you finance part of the purchase of real estate?
That's yes, you can, and that's another entire presentation.
Okay. Here's your next question.
Okay.
Your next question is, once Ann retires, the IRA can continue to own the home and collect rents, and Ann can pull funds from the IRA, paying the appropriate taxes as she removes funds, right?
Correct.
Correct. What happens if you purchase a rental with your IRA and the expenses outpace the income? Then a major repair comes up and there's not enough balance in the IRA to cover that current expense. What happens then? That's
a problem, and that's why there needs to be some money held back to do that. Now, just like you had asked 2 questions, IRAs can borrow money. So in this case, an IRA could go out and borrow money for this repair, as long as it's not from a disqualified person. Money can be put into the account as borrowed funds, pay the expense, and then as the IRA account is paid its rent, can pay on the note for the borrowed funds. So it can work that way.
Okay. Can you buy a home and flip a home?
Yes. Prior to 2008, we had a number of people doing that. But again, when you do that, if you buy it and you rehab it, all expenses for that rehab have to come out of the IRA. And you cannot do it yourself, because the IRS says that you are providing services to your IRA and that you are making non-cash contributions by doing the sweat equity yourself.
Okay.
and it's increasing the value of the property.
You just answered the next question. So, can a husband's property management company manage a property bought with the wife's IRA?
No, because the wife is a disqualified person to the husband's IRA.
For a security deposit from a tenant, can the IRA hold that even though it's not a contribution?
Yes, because it's considered just like rent. Sometimes it's last month's rent, but a security deposit, any quote income is put into the IRA, and then at the end of the lease term, if the tenant is leaving after the walkthrough's been done, if they're due any refund, then that would come out of the IRA.
Okay. Can a self-directed IRA own a fractional ownership in a home where the person living in the home is actually the other fractional owner?
Yes, as long as the other fractional owner is not using their IRA to purchase it, if they're just the outright person and that other fractional owner is not a disqualified person.
What are the general lending restrictions on an IRA purchasing real estate if there isn't enough money in the IRA to purchase a rental property outright? Minimum down payment percentage, restrictions of the type of property, single family versus condo, home square footage requirement. I know you're not a lender, but what general restrictions do lenders have? Because I believe it has to be non-recourse lending, which is different.
Yes, that is correct. As we said, IRAs can borrow money, and if it's on the purchase of assets like we're talking about here, it has to be a non-recourse loan, which means you cannot personally guarantee the loan. The property stands for itself. There are probably 3 that I'm aware of in the industry whose business it is to lend to IRAs. Overall, and of course each one's going to be, each individual is going to be different, but as a general rule, they won't lend on anything less than $50,000. So if you're looking to borrow less than that, they're not going to do it. The interest rate's about 3/4 of a percentage point more that you can find in conventional. They do have fixed terms, 15 and 30-year fixed. The loan to value is anywhere from 60 to 70% loan to value. It must be income producing property. It cannot be just like unimproved land or subdivision lots or anything like that. So, and it usually takes them about 45 days once you contact them for them to close. And that's pretty much across the board on all of them. But again, the specifics are going to be based on the individual property.
Okay. I think you answered once the tenant is placed if a needed repair exceeds a balance in the IRA. You already talked about how that's handled, correct?
Right. And then also on there is obviously you can make contributions because every year you can make a contribution to your IRA.
Okay. And if I own the property management company, can I have one of my property managers manage my self-directed IRA property?
No.
Okay. Are there any special considerations for property management companies to be aware of when dealing with self-directed properties?
Not really, because it's just like any other property. It's just that the entity that owns it is the IRA as opposed to the individual. The individual makes the makes the decisions. It's just that you've got this third party, the custodian, that is actually doing the funding and the collecting, or is where you send the rents.
Can a property management become a registered IRA custodian?
No. There are only certain, their IRS is pretty much the only one that can give that custodianship to them, and they're really limited it to brokerage companies and banks and trust companies. And so that's pretty much the only people that can actually hold IRAs.
Can borrowed money be used to purchase property for an IRA?
Yes, and we talked about that on what can and can't be done.
Can a property manager manage their properties in their own IRA if they do it without charging fees for the service?
No. Again, because you are a disqualified person, just like you can't rent, just like you can't go and pay rent as a tenant in a property that you own, you cannot manage your own properties in any way.
What is the max that can be put into a self-directed IRA yearly?
Depending on the type, because we talked about the different types, but if you're talking about like a traditional and a Roth, it's this year, it's $5,500 plus there's a $1,000 catch-up contribution if you're over 50. If you're looking at a SEP and a simple, those are much larger, and depending on how much you make, can be up into the $50,000 range.
Is property insurance handled any differently for a property owned by an IRA?
Not at all. Yeah, it's just titled in the name of the IRA as opposed to the individual, which is not a problem with, the major insurance and even the minor insurance companies.
What is the difference between the management fee on a self-directed IRA versus the other IRAs?
Generally, the cost of a self-directed IRA is the first year runs about $500, and then every year after that it runs about $300 if we're talking about one asset, which is probably about what you pay anyway outside the IRA. It's just that those fees are hidden in the mutual fund disclosure statement about the percentages that you do. So you're paying somebody no matter which type of IRA you've got. It's just that some of them are more hidden than others.
Can the rent received and deposited back into the IRA exceed $5,500 per year?
Yes, because there's no limitation on the amount of money that can be made in an IRA. So if you've got a property and you're collecting $1,100 a month, then that is, as an example, that's just like dividends from stock. And so there's no limitation on the amount of money that the asset can earn. There's only a limitation on the amount of money that you can contribute. So in Ann's case, in the case study, if she's got rents coming in $1,000 a month, that's going to be $12,000 a year. It's not a problem because it's off of the asset within her IRA. If she sells it for a profit and she makes a $40,000 profit on it, all that money goes back into the IRA because it was an asset within the IRA. The limitations are only on contributions.
Follow-up to the security deposit question. Is the IRA required to hold the security deposit? Can a property manager hold the deposit instead?
The property manager can hold it if that's part of the agreement between the IRA owner and the property manager. If that's a term that is within, required by the property manager for all of their properties, then yes, that's fine. It'd just be part of the escrow that they keep.
Does the IRA receive a W-1099?
It will if there are certain things. The 1099 is generated every year in January for people that have taken money out of their IRA for whatever reason. So yes, these self-directed IRAs would also generate 1099s and sent to the owners. And also in May, all IRAs will get what's known as a 5498, and that's also generated from self-directed IRAs. And both of those, just like with any other IRA, are reported to the IRS.
To clarify, do I, as a property management company, provide a 1099 to the IRA?
Yes.
Okay. All right. Are you aware of any property insurance issues with an IRA owning a property?
No, not at all. Like I said, we've got all types, liability insurance, any damage or anything like that, and when it's titled in the name of the IRA, if there is a claim, then the insurance company makes the check out to the IRA, then it's deposited in the IRA, and then the IRA pays for the repairs and expenses.
If I own a property management company, can one of my employees own a home in a self-directed IRA and allow the company to manage it?
If they are strictly an employee and are not part of the company and there's no undue influence involved, then yes.
Can my IRA lend someone money for a down payment, and is there a minimum interest rate I must charge?
An IRA can lend money, so yes, you can lend it for down payment or for any other thing that may be done. There's, you know, it really probably should be within a market rate when you're lending. Obviously, there are usury laws that are in place in different states, so you don't want to exceed those. So you just need to look and see what those are. But there's really not a a standard or anything when you're doing these type of loans. Obviously, you've got hard money loans, hard money lenders outside the IRA. There are people, these same hard money lenders have IRAs and use their IRAs to make loans. So so it's just like you would as if it was outside the IRA. There are no differences.
Okay. The IRA, oh, I'm sorry. So if an owner of a self-directed IRA who is not a property manager as a line of work cannot manage their own property, then it must be managed by a non-disqualified person. So all properties in self-directed IRAs are professionally managed?
They're not, well, in my opinion, they should be. And the reason I say that, and that's why I mentioned it in the presentation, is that the code specifically says that you cannot provide, you, the IRA owner, cannot provide services to your IRA. But the code doesn't say, doesn't define those services. So if you're, if you're looking for tenants, if you're doing background checks, if you're getting the maintenance people, if you're collecting rents, in my opinion, that's a service. And maybe just one of those may not be a service, but when you start aggregating all those things, to me, and I think eventually to the IRS, that's a service. And that's why we strongly recommend that anybody that purchases real estate within their IRA use a property manager.
Okay. What if we help an investor buy a home with their IRA, but they want to manage their own property? So owner managed?
Yeah, again, you can. Helping them do that is fine. If you sell the property, that's fine too, and they choose to manage it over after being informed of all of what I just talked about, then yes, there's nothing today that limits them from managing it themselves.
Okay, Bill, that looks like the end of our questions. NARPM thanks you for taking the time to present this very worthwhile educational webinar. Again,
well, I appreciate you having me.
Certainly. Again, this session is being videoed, and you can look at the recording tomorrow at the linked page. Also, make sure you review all the upcoming events that NARPM has going on at our website at www.narpm.org/conferences. We thank you for joining us today, and we'll see you at our next webinar in April.
Great. Thank you.
Thank you, Bill.
Bye.